Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Tariffs top the worry list as earnings season kicks into high gear. In the industrials and energy sectors, leaders point to rising input costs and choppy demand, both driven by tariff uncertainty. So how are our next guests navigating the noise and still finding pockets of growth? And why might today's environment be the perfect storm, actually, for long-term opportunity? Joining us here today for a closer look at how tariffs are impacting the global energy and the U.S. industrial sectors are equity research analysts Hwang and Payton Liske. Great to see you again, Jin. Welcome back, Payton. Great to see you both.
Thanks for having us.
Yeah. Jin, I'll begin with you. You take a look at the energy sector. We can begin with the oil price, but we'll go in lots of different directions here. The macro story for demand and supply, I wonder if you'll just outline that for us, because it does feel like a new era, if you will, on that front.
Sure, yeah. And it's challenging because as we think about the rest of the economy and the rest of the markets, we're facing a battle on one front, which is demand as a function of the uncertainty created by these tariffs. In the oil markets, you're obviously having the two-sided impact of not only the demand discussion, but also on the supply discussion.
There's too much.
We've talked about this last time, but a lot of that kind of new developments globally, whether it's Guyana, Brazil, Argentina, there's a lot of new barrels coming online this year. We've had really strong oil prices coming out of COVID. It incentivized a lot of new projects to be developed. And unfortunately, a lot of that comes online this year. Factor in on top of that, a lot of these new OPEC announcements around potentially adding a lot more barrels. And you sort of have a pretty challenging kind of setup in this world. The one bright spot as I look about this kind of challenging setup is, look, when everyone wants to sell the sector, they sell it indiscriminately. And that creates opportunities in certain pockets that we're kind of chasing after right now.
Okay. Oh, super interesting. Okay, we'll get into that a bit more. You're looking at U.S. industrials. This includes the defense, it's the transports as well. Give us a little bit of an overview. We know the tariff story, and it's obviously affecting some very serious areas that you look at. But in a way, it's meant to help them long term because they're U.S. industrials, isn't it? It's meant to be the nearshoring nexus.
That's right. Yeah, I think there's a varying range of impacts across my space. The most acute being obviously within transports, not necessarily direct impacts from a cost perspective, but indirect from how these tariffs impact freight demand across the U.S. and coming from China. Clearly, we're facing what looks like an import cliff over the next couple of quarters. So I think most companies are bracing for what's going to be a pretty challenging Q2. But I think there's some silver linings in this, and I think a big part of it is understanding kind of where we're coming from. A lot of the companies that I've looked at across transports, they've already been in a downturn for the last 2.5 years. In some cases, worse than the global financial crisis levels. So they're coming off of fairly depressed bases, and I think the silver lining here is that potential demand shock could help clear some of this excess capacity that we've had through the post-COVID era.
Does that mean people?
Mainly, yeah, capacity on the truck side particularly, which has really kind of muted any recovery. And so I think the silver lining here is if we look out to a couple of years through a recovery scenario, we could actually see a much healthier upcycle within transports.
That's really interesting. So sort of clearing the decks a little bit for a healthier cycle ahead. And we'll talk a lot about the long term. Let's get into right now and the port story because it fits with the imports cliff. And ultimately, we spoke recently and you said you're looking very carefully, obviously, at what's coming in to build the various industrials and also to be powered by, ultimately, an energy complex. How much is at stake at sort of this import? What are you watching to watch the import story? We're a month out, right, from Liberation Day?
Mm-hmm. Yeah, I think the leading indicators that are sort of most relevant right now are sort of shipments into the west coast of North America from Asia. And what's interesting is if you just look at container ship leaving China coming into the west coast of the United States, typically takes 30 days point to point. Obviously, Liberation Day was about a month ago, but there would be a bit of a lag from when you start to cancel orders coming over from Asia because of the tariffs you now face. If you think about orders starting to be canceled, kind of mid-April, a bit late April, we still haven't actually seen the dramatic impacts of the tariffs on the port arrivals. And so what you should expect to see is from now until through really the end of May, you should see port activity on the West Coast continue to come down. And if you think about the cascading impacts of what that looks like, obviously less stuff on the shelves for consumers, businesses try to produce, but they don't have the intermediate goods coming in from China to support that manufacturing. And to Payton's point around transportation.
Like steel,
exactly.
All the things that have tariffs on them.
Exactly. And then to kind of Payton's point around transportation, if there's less stuff coming in at the West Coast ports, do you need that many trucks to actually transport goods across? Probably not, which means do you need as much diesel? So it goes back to, again, the demand side of the picture looks fuzzy, the supply side of the picture looks fuzzy, but these are kind of the main things that we're thinking about as we try to now cast, I guess, as opposed to forecast what the world looks like.
That's super helpful, just taking a look at sort of the initial and then take a couple standard deviations away from. Anything to add to that? You're obviously looking at the ports as well. It's part of it.
Yeah, no, I think, to Jin's point, like volumes are expected to be down pretty considerably. The question is just around the duration of what that looks like, because it sounds like from the feedback we got in Q1 from transports listening to their customers is, some of them actually have the inventory to be able to withstand maybe 3-4 weeks of delaying decisions. But then after that,
because they've pulled forward.
Yeah, there is probably some amount of pull forward that we saw. But then after that, they have to start to take risk and try to forecast what they think demand is and start to, reorder. So I don't think it's feasible that we see imports down 30% for an extended period of time. But at the same time, it is going to be an acute shock, I think, to the system.
I mean, if it's not sustainable, it starts to take you into the question of if there will be some sort of deal with China, will be some sort of clearing of the relations there. We went into this in Canada about lots of things as well. I don't know. Do you want to just dip your toe in there? You obviously don't know, but something needs to happen before you have to reorder, essentially. Is that about right?
Yeah, I think that's fair. And, the relations themselves, we're not going to be able to comment on. I know.
Nobody knows.
Bogey, but the more concerning fact is, I think the uncertainty alone is enough to atrophy the economy for some period. If you don't know if you're going to face 125% tariffs, 0 tariffs, 10% tariffs, can you really start that next big project? Can you really order that next batch of inventory? Probably not. And so the longer we're in this uncertainty period, kind of the more likely we are to face a slowdown, even if we actually don't see these tariffs kind of implemented for a long period. So that's what we're watching. It's not only, again, kind of the port activity or employment or anything like that, but just the duration of uncertainty that we face and how that will bleed into sentiment as we kind of go through the rest of this year.
I mean, sentiment, it's been rough. We've been waiting for hard data, which hasn't really come, actually. Let's talk a little bit about the pricing in for a recession. Doesn't mean it's necessarily on the way for sure, but are companies doing that? Are investors watching for that?
I think so. I think in certain pockets
of what your universe.
Of what my universe is within transports, again, acutely in the eye of the storm, maximum levels of uncertainty, a wide range of outcomes that typically leads to some sorts of mispricings. And I think we're starting to see the early signs of that. We're now seeing some valuations on some transportation companies that are approaching hard asset values, which tends to be a pretty good long-term floor. A couple of anecdotes. There's a few trucking companies that are very good operators that have 30+ year histories, gone through many cycles. We've actually just seen them print the first losses ever in their 30-year history of being public. So it just gives you a sense of how bad things are. Not to say they can't get any worse, but again, the market being a forward discounting mechanism is already, I think, beginning to price that in. And so there, I think, are beginning to be some really interesting kind of opportunities if we're able to take some duration.
That's mostly on sort of transport. What about defense? Let's just go into some of the areas of what you cover.
Yeah.
This is U.S. defense.
It's not all doom and gloom. So aerospace is actually one of the best performing sectors within industrials. They've a few of these companies that we own and follow closely have had exceptional results, actually beat earnings estimates. They're raising guidance into this tariff uncertainty. And I think a lot of that just speaks to the quality of these businesses and the fact that they are a little bit less cyclical from a economic sensitivity perspective. They have real pricing power, and so they're doing exactly as we would expect. They have really healthy balance sheets. They're investing in their businesses. They're looking to acquire at discounted valuations if they can get them. So I think they're doing all the right things to create value for shareholders. On the defense side, we came into the year with, I think, again, a pretty wide range of outcomes with a view that, DOGE and potentially some fiscal austerity could put pressure on defense budgets, particularly in the US. We're starting to see that ease a little bit. I was actually just reading this morning, it looks like there could potentially be an increase to the US defense budget this year, which was not expected, January. Yeah. So I think the outlook for U.S. defense is improving, and these are obviously defensive businesses, not really tied to the economic cycle, and so tend to still be safe havens.
within a recessionary environment should that come. What about across the energy sector in different areas? I mean, it's also a defensive play. We're going to use energy whether we are in a recession or not. That said, what sort of pricing have you seen? Maybe it's going up.
Yeah, so on the oil side, it's certainly been challenging. Sentiment's been very poor as a function of the fuzziness that I kind of talked about, both demand and supply. But what's actually helpful for us is in those scary environments, correlations on everything effectively goes to 1. So everything almost trades uniformly.
Right.
Because of that, there's pockets, again, where there's more non-discretionary safety type plays where you can find opportunities.
Where?
Two in particular that kind of stand out today. The first is natural gas.
Yeah.
Look, natural gas is effectively a non-discretionary kind of consumption item. Outside of kind of factory demand, you're still seeing heating demand, you're also seeing power generation. It's all ultimately required. And on top of that, we have the stories around LNG developments in US and Canada. You're seeing the AI data center theme still continue to play out to this day. You think about turbine cells out of a lot of these companies. They're sold out for a very, very long time. So the natural gas side.
So the natural gas side. I was just going to say on the AI side of things, it did seem like that was huge. And then did we forget about it? Or, I mean, it seems like it's just gotten a bit quieter. Maybe there's other
100%.
noise.
Yeah, and this is where you have to kind of diffuse sort of the noise versus what's actually happening on the ground. And, because we're such a large team, we're able to speak to these companies and what they're seeing on the ground these days. So the narrative has been the market's coming down, growth is going to start coming down. And because of that, we have to start discounting all the growth that we saw, well into the end of this decade. On the ground, it's a very different story. You're seeing a lot of these large hyperscalers talking about a lot more capital, the development of new data centers. And even as you look across the supply chain, again, the turbine manufacturers are the nexus of this kind of whole supply chain. They're still sold out for the next several years, and they're seeing too much demand for what they can manage right now. So the gas story still very much remains intact and exciting despite all of this that we're seeing right now.
Okay, let's talk a little bit about sort of within the industrial story, but the energy story. This is the question of pipelines. In Canada in particular, we've just had an election. We have some certainty with what party is going to be leading. We do not know what the policy is. There have been some indications. I'm interested in both of your views of sort of the direction that it would be useful for investors ultimately on this front. If you go ahead and take a stab at that, Jim.
Yeah, it's been challenging because there's been a bit of conflicting messages coming out of the current party. From my understanding, I think we're going to take a pragmatic approach here. And the biggest challenge from the last couple of years has not been the policy per se, but again, the uncertainty.
Right.
If you don't know that within a couple of years, there's going to be a strict emissions cap or no more pipeline capacity, can you really do that much with your business? Probably not. What I think Mark Carney and the Liberal Party can do here is actually set a pretty clear foundation of this is what you can expect over the next couple of years, whether it's positive or negative, we're not really sure. Such that
they might be announcing it now, actually. So in any case.
Which we're willing to take live feedback on that. But the uncertainty, alleviating that alone should be enough to actually help spur investment and start getting companies to think the right way. Because again, the only thing worse than sort of a bad policy, I think, is just lingering uncertainty around a policy.
Yeah. What about the building of it all? This is sort of the industrial side. I know you're looking at the US, but we're all going to be building, aren't we, across this continent?
Yeah, I think it just kind of comes back to any policies that go towards spurring investment domestically is going to be helpful for a lot of the companies that I cover in the broader industrial complex, right? I mean, U.S. industrial production has kind of been flat for the last decade plus, and a lot of that is just because we haven't invested, both domestic companies as well as foreign. So I think the policies that are being targeted both in the U.S. and Canada look to be aiming towards trying to make it more friendly to be bringing back dollars into these countries, and that should help to increase overall industrial output, which is positive for a lot of the companies I cover.
Does it matter where your money's coming from, if it's foreign direct investment or it's just spurring investment, which I guess don't really care, but
I think
what do you see there?
Well, I mean, we're seeing a broad range of announcements. A lot of it is coming forward, and I think a lot of that's tied to the fact that it's a bargaining tool for reducing your tariff impact, right? And I think that was part of the idea behind this. So I think a lot of it is starting foreign, but I think we're also I'm also hearing quite a bit domestically as well. There's the railroads that I cover on the eastern part of the U.S. They're talking a lot about the funnel of projects just continues to grow despite the fact there is a lot of uncertainty here. So that's a really good sign. It takes years, it's not going to happen overnight, but it's a really good sign for volume activity kind of as we move into 26, 27, 28.
Okay, fascinating. Anything to add to that, just to sort of the spreading out of energy across this country, specifically taking a look at whether we're going to use our own energy in a different way.
Yeah, and we spoke about this in the past about kind of the need and sort of the wake-up call we needed that, you know what, Canada has a lot of natural resources. Why not tap into it to, you know, really drive that GDP per capita growth that we're really looking for? And yeah, there's tons of opportunities for it, not just with a new pipeline that we could potentially develop, but even with the existing system.
Right.
There's been a lot of development over the last couple of years that, you know, cheap debottlenecking opportunities. You can unlock a lot of capacity in a way that gives us visibility even to this end of this decade.
Like just expanding a pipeline
Exactly,
that is there,
exactly.
for instance.
It's
Okay.
cheap, it's efficient, it can be done fairly quickly. And if you have the pipeline visibility and you have a somewhat pragmatic government overlaying that, you know, it's kind of sky's the limit for Canadian energy if you think about sort of how much resource we have.
So the existing pipelines do not run across the country from west to east, but they are more sort of Alberta to the west coast. That possibly could be expanded. How, it sounds difficult, but how difficult is it to piece together across the country? I mean, in terms of timeline, is it just far out of sight?
Yeah, the timeline's far out. There is ability to leverage past projects, specifically Energy East, which was a former TC Energy project that everyone is kind of talking about these days. The challenge is a lot of that, the pieces there have been repurposed kind of here and there. So
they owned chunks of where the land would be.
Exactly.
But it's been...
Stitching it together these days would be difficult. But look, with a conducive government and kind of a supportive government, you know, there really is no limit to what we can do. Given, again, the governor on growth really is just the amount of resource, and Canada, again, has among the highest oil reserves in the world that we're not using.
Right. So powering some of that. Question, this will go to Payton. Do you have any thoughts on the conversion of trucks to electric vehicles and the impact that this may have on the industry? Has that slowed down?
I don't know if it's slowed down. I think there's a lot of work still going on behind the scenes, but I think it's going to take quite a bit of time before we see, you know, length of haul moves, 1,500 miles plus across country on highways that are done completely autonomously. You know, I'm obviously tracking that quite a bit because I think it can have a fairly substantial impact on the competitive set within the trucking domain, right? But you know, I think that we're still years away from that technology actually being commercially feasible.
Right. What about the story of a powering of either new mines, or which also seem like they'll take 10 years to build, so it's a long story, but similar to data centers needing constant feeding, there are lots of projects across the country that we think are going to be easier to get shovels in the ground on. Is there a discussion around that?
Yeah, what's interesting is we actually don't even have the conversation of large greenfield new projects these days. I think a lot of the energy companies have built up pretty massive inventories of cheap debottlenecking projects within their existing base, where all you really need is just reduced uncertainty. And if you can get the reduced uncertainty and some support that, look, we do need to diversify our trade partners, then I think, again, we can unlock things at a very cheap level and a level that's really supportive for kind of resource growth here in Canada.
In the spirit of now casting, where things have come a little bit to a halt in a lot of cases, versus looking at something like that with a little bit of opportunity. I guess you just sort of wonder how that gets unstuck. Is it just an announcement and we'll see things pour in? Or, I mean, what are some of your thoughts on that? Is it just a signal we're waiting for, or is it, do you have to kind of have shovel-ready projects?
Yeah, I think, you know, the signal obviously is really important, and getting the framework in place is critical, and I think that that's what everyone's kind of trying to work towards here. But I think you touched on an interesting point, right? Is like once we have that signal, the framework is in place, the capacity to do it, right?
Yeah.
I mean, we've been in a labor-constrained environment for the last 4 years, right? And I don't think that's gotten a whole lot better. So I think that, you know, that is going to be a challenge that we'll have to work through. But I think just having more certainty is just going to be a huge benefit. And
let's go to earnings forecasting guidance. You mentioned a bit of it there. I mean, there's all kinds of companies that have just taken a pass on guidance, actually, and they've sort of been allowed to, and you can see why they might go there. That said, I think some of the companies that you're following have kind of kept their guidance intact for now. How do you see Q2 in terms of communication along with the earnings themselves coming? Maybe, Jen, you can start us off there. Things have been left intact somewhat now.
Yeah, I think Q1 has not been a great signal for folks only because everyone acknowledges that there may have been a bit of a pull forward ahead of tariffs in this first quarter.
So it looks quite good.
It looks quite good,
Yeah.
exactly. Not reflective of, again, the nowcast type of economy. And equally, because of so much uncertainty, they're willing to just leave sort of the guidance intact until we have better signals otherwise. Again, going back to the view of kind of focusing on the nowcast, the conditions we're potentially starting to see, especially again with the port activity that we talked about, would suggest the Q1 economy is not reflective of go forward. And so
Right.
Q2 could be the pivotal moment when we start to see things start to change. But again, it is hard to call the duration. But if we can go to the 30-day timeline from
Right.
kind of port to port, it would suggest that we should start to see some of that bleed through now. And Q2 will be the one that all investors are watching for on the misses, the guidance, things like that.
Okay, anything to add to that? I mean, I'm sure it's similar, but
No, I agree with Jim. That I think broadly correlates with what I would expect across the transportation space. But within my coverage, I'd also like to highlight, there's some really long cycle demand across the aerospace and the defense space, right? So, I look out on the OEM order books in commercial. We're looking out 7 to 8 years, so we have really strong demand visibility. We've been in a supply constrained environment actually the last 4 years.
tell us about the demand. What's it made up of exactly?
Well, I mean, it's really just a catch up.
Okay.
In terms of order books, trying to catch up to where forecasted demand is. We've seen utilization of legacy fleets and retirement levels, well below historical averages for the last 5 years, and a big part of that is because OEMs have had so much trouble ramping up production, and so we've been undersupplying the market for going on 6 years almost now. And so we're coming from a really healthy place from a production level because we've got a long way to go to get to normalized, and we've got really strong demand signals still there. So across the commercial aerospace and even the defense side, I would say Q2 is far less of a concern, but clearly some acute challenges that will be in the transport space.
Yeah. So the OEMs, like the planes, we're still going to have sort of rickety, a bit sticky seats in some of those planes.
We could.
There's
Yes.
nothing.
We could.
You're sort of like, oh, they landed, but everything is shaken inside. Okay, all right, so then we'll just continue on with that a little bit. In both of your industries, let's talk about the dynamic of investment that is a little bit of an everything else trade, mostly to U.S. assets. This has been part of the market story this year thus far. There's been a real interest in diversifying away from U.S. assets. I don't know if that shows up in the same way, probably in our industry, but just speak to that a little bit. It's been a powerful market diversifier this year.
Yeah, I think Canada has definitely benefited from that to a decent degree. There's been a lot of investors globally that have really wanted to look at the Canadian energy space because of how much resource these Canadian companies actually do have. The whole idea is that, look, US companies, phenomenal businesses, have done very well over time, but there's not that much resource there. Whereas in Canada, we still have the third or fourth largest reserves globally, not really being used. So the growth potential there is massive. So there has been a backlog of folks wanting to come back to Canada at some point. And now that we've cleared kind of US dominance into kind of more global picture, and on top of that, we now have potential visibility around the government, I think you could see that start to really come back. And again, it will depend on how the oil market does play out. But again, back to the points around where there is opportunity, we spoke about gas, but even on the infrastructure side, right? These businesses have gotten a lot better, a lot cleaner, balance sheets are better, costs are better.
And they're efficient at getting oil out of the
Much
ground.
more efficient, and that was a product of COVID, right? If you hit a near-death scenario, you naturally have to find ways to adapt. And we've seen that over the last couple of years in a way where it doesn't really matter at these prices. We speak to companies fairly frequently. No one's really blinking at this oil price just yet, and that means the volumes will still flow. What do you want to play in that type of environment where you don't really want to take the firm commodity view? You want to play the folks who manage the barrels, the molecules flowing from point A to point B.
Volumes.
Exactly. In a lot of cases, again, these Canadian businesses have really, really strong networks all across the Western kind of area.
Fascinating. You are looking at U.S. assets. What have you seen there on this market dynamic?
Been a whole lot of impact on my coverage specifically, but I would say like generally across industrials, we've seen that impact relative multiples. We saw the relative multiple spread towards the U.S. versus Europe widen to one of its like highest historical levels over a couple of decades in the last call it 1 to 2 years, and a lot of that's just been driven by the relative growth spread, and that seems to be kind of narrowing as you're seeing a lot more an increase on fiscal policy coming out of Europe. I've seen it a little bit on the defense side, but I think part
that
of
is fiscal policy coming out of Europe, isn't it? The
definitely,
defense side?
yeah. We're seeing again a lot of this is driven by relative growth spreads, and we're seeing relative growth among the European defense names. Almost double what the U.S. can put up now, and they're now trading at, in some cases, pretty significant premiums to the U.S. defense primes, which hasn't historically been the case. So we are seeing some of it there.
To use Jay Powell's term, would that be transitory?
I don't think it is, because I think it's these are very long cycle trends, right? And I think the European defense spending uplift is not going to be 1 or 2 years. I think it's going to be multiple years, and in which case I think you have some duration to that relative earnings growth spread.
So we talk a lot about the tariff story within North America and what it means to Canadians and sort of living it here. I mentioned a deal with China, but just kind of the global tariff story in creating certainty. What would be useful, taking a look at your industry, if, a deal was struck with the EU or something else? Just talk about sort of the global uncertainty being unstuck for your industry.
Yeah, it is a high hurdle, only because, what's said one day could be meaningless the next day. Yeah. And so I think you do need, for one, pretty firm deals with a lot of these different countries, but also kind of a commitment that these deals are going to be in place for a long period. It's something that I'm watching with particular focus, only because, again, the U.S. is obviously massively important to the oil markets. But if you think about where the vast majority of oil demand growth has been over the last 10, 15, 20 years globally, it's been a lot of these emerging markets, right? And right now they're sort of at a crossroads as to what's going to happen. So once we start to see the cascading impacts of, okay, we have the China deal, we have kind of these sequential deals coming through, I feel like you start to see a little more confidence there. But again, it is at the end of kind of that bullwhip, and it's going to take some time before we see the full confidence roll through all the way across the board. So It is something we are watching. Okay.
And also to you, Payton, sort of the international tariff story, ex-Canada, and what we live every day.
Yeah, I'm in these types of environments trying to predict less and just understand what's implied by price more, and really focusing on that and allowing that to kind of drive our decision making. And like I was saying, I think if you look at what's implied in price in some of these more acutely focused areas within transports that are impacted by tariffs today, I would think that we're leaning a little more towards the pessimistic range of outcomes, and that starts to look a little bit more attractive, particularly when you've got really good management teams, strong balance sheets that can weather through a couple of quarters if we have to of pretty poor demand scenarios. So.
Well, it's great to have you here now looking at a longer term story, because that sounds like exactly what it is. So shipping is being directed from Asia. Will this benefit Canadian West Coast ports? Could our rail system benefit? I think both of you could probably lean into this a bit, but yeah, where are the benefits from this disruption? Are they in Canada?
Yeah, in Canada, a particular focus has been on propane exports. So again, this is a byproduct of oil production. The U.S. has historically basically supplied all of China's growth for the last 5 years coming out of COVID. And Canada is now, there's more discussion of new capacity being added in a way where we could fill the deficit should that relationship continue to fray. And because of how cheap and economic a lot of our resources, we are able to take advantage of a lot of those, a lot of that friction there.
Okay, that's really interesting. Anything, West Coast ports?
We actually had a miniature example of this through the prior Trump administration when he ramped up tariffs on China, obviously to a much lesser extent. And what we saw during that period was volume shifted from the West Coast to the East Coast as companies started to change their origin sourcing more towards, India and Vietnam, which were pretty big beneficiaries. From listening to companies, it sounds like that has only accelerated. But I think a lot of that move has been playing out slowly over the last 4 to 5 years. So we're probably in the later innings of that, I would think. But my view would be it probably swings more to the East Coast, and you continue to see East Coast volumes benefit more.
Fascinating to get both of your views. Thank you very much for your time joining us here today. See you soon.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.